Hey everyone, good afternoon, right? It is afternoon right now, so good afternoon, everyone. Hope your day is going well. My name is Nonye, and I will be working on the Zoom today. And yeah, hope you had a great weekend and your Monday has started off well. So today we'll be covering financing, all right? And I'll just put it here. If you wanted to jump in to the Zoom with me and perhaps ask a question, let me know and I can easily bring you on to ask a question because it'll be more real time than if you are asking it on YouTube. So if you're asking it on YouTube, it's a little delayed, I think by a minute or so. But if you want to jump on Zoom with me in any of these live sessions, let me know and we can organize that for you. All right. So today, when we talk about finance, what we're going to talk about are the things that you need to know for the exam. All right. So what I'm going to do is I'm going to share my screen and share the candidate handbook as well, because we want to use that as our guide. Now, here's the handbook, and I did share the link previously, and if anyone needs the link, just let me know. It's usually in the description box, so you could grab the link from there and go to this document. Now, the link will take you to the most recent one. The one I have now is updated as of July 2022, and that's the most current one I found on their website as of the recording of this video. Okay, so be sure to check the link just to make sure it hasn't been updated since I pulled it off and what's on the screen right now. So today we're going to talk about financing, and it is about 10% of the national portion of the examination. So that's, something you need to be aware of. And as you can see, there's A, B, C, yeah. So there are different categories as well. So we'll touch on a few things here. With financing, the other reason why it is essential is because most of your clients are going to be getting financing for their purchase. So not everyone's going to be paying cash. And so you will be working with people who are getting mortgage loans. Therefore, you need to understand how the process works. So first thing there is the basic concepts and terminologies, right? Know what points are. A point is what you pay to essentially reduce your interest rate. So you could reduce it by 1 point. You could reduce your interest rate either for the life of your loan or temporarily. Now, what you need to remember for the exam is two things. You reduce your interest rate by paying with the points. And how do they calculate points? 1 point is 1% of the loan amount, okay? Not the purchase price, the loan amount. So 1% of the loan amount is how much the buyer or the borrower will be paying to buy down the points. Now, 1 point essentially reduces the what you call this thing now? I'm blanking. Reduces the interest rate by 1/8%. So to reduce it by 1/8 of a percentage, you pay 1 point. How much is 1 point? 1% of your loan amount. If you wanted to reduce it by 2/8, so 2 points, then you will pay 2% of your loan amount. Sometimes it could be a fraction of a point, and so it will be a fraction instead of the loan amount. So let's say it's 0.5 or half of a point. So it'll be 0.5% of the loan amount. That's what the borrower will be paying at closing. So let me pull up an example here on the screen and I will show you what that looks like. So let me share a different screen. Give me 1 second here. I have too many things running at the same time. Okay, so sharing a different screen. Let's go back and share here. Okay, so on the screen now you see discount points to the investor. So like I was mentioning earlier, 1 point reduces the loan amount by 1/8 of a percentage. Sorry, reduces the interest rate by 1/8 of a percentage. And then for the borrower, they would have to pay 1 point or 1% of the loan amount. And then if it's 2, it's 2 points. So the example I gave earlier, if we were reducing it by 2/8 of a percent, so that's 2 points, then we will be doing 2% off the loan amount. Now, the exam may ask you the question where, for example, they give you the purchase price, but they don't actually give you the exact loan amount. So you need to solve for the loan amount before you calculate the points. Okay, so you need to solve for the loan amount before you calculate the points. And I have an example that I will pull up so that, just to give you a little review of what that would look like. Okay, so all right. Next thing on that list on the list in our candidate handbook is loan to value or LTV. So with the loan to value, what it means is that the loan amount to the value of the property. So for example, if I have a loan for $100,000 and I'm putting down 20%, okay? So $100,000 multiplied by 20% is $20,000, okay? Just to make the math easy. So I'm putting 20% down, I'm paying 20%, so $20,000 down, meaning I'm getting a loan for 100 minus 20, which is 80. And so 80,000 divided by 100,000 gives you 80%, and that's your loan to value ratio. And you should have an example of this in your book. But let me share my screen again, and I will do one here on the fly. Okay. So earlier I said, if you wanted to jump in on the Zoom with me, let me know, maybe for a future one, and we can arrange that. I can get you the Zoom link and add you on, so you could ask like real-time questions, because the YouTube is, I think it's about a minute delayed. All right, so keep that in mind as well when you're asking questions in the chat. All right, so we were just talking about LTV. So let me just essentially show you in writing what I was just mentioning. So if my purchase price, my value, okay, is 100,000, okay, and my down payment is 20,000, right? So I'm using simple numbers here so that you're able to quickly calculate it, but it could be any numbers, okay? And the same concept will apply. So this is my down payment, okay? Meaning my loan would be 100 minus 20, which is 80,000. Okay, $80,000. So when we talk about LTV, loan to value, so we mean the loan amount to the value of the property. So the 80,000 to or divided by the value, sorry, 100,000. All right, that should be 100. $100,000 here, okay? And then you want to express this as a percentage. So what you would do in your calculator would be 80,000 divided by 100,000. And either if you hit sometimes if you, depending on the calculator you're using, if you hit the percentage key, then you should get 80%. But if you don't, you multiply what you get by 100. Okay, so in this instance, our loan to value ratio is 80%. Okay, now another quick way to know the loan to value without having to do this math that I did here is this. Let me change my ink color real quick. So if they tell you the down payment is 20,000, all right, what's the loan to value? You could then find out what 20,000 is as a percentage of the value as well. So earlier when I was saying this, I told you it was 20%. Okay, so let's say instead the question was like this. A homeowner, a borrower is purchasing a home valued at $100,000 and will be putting a down payment of 20%. What is the loan to value? Okay, so purchase price or the value of the property is 100,000. Down payment is 20%. Loan to value, simple, is 100 minus your 20%, and that gives you 80%. All right, so your loan to value plus your down payment should equal your purchase price. So your loan to value, 80%, for example, and your down payment, 20%, will equal 100. It could also be your loan to value could be 70%, and then your down payment is 30%. So then that equals 100. It could be 60-40, it could be 95-5. So whatever it is, essentially, it's adding up to 100% at the end of the day. All right. So let me look real quick on YouTube and see if there are any questions. Okay, awesome. Mr. Goodfellow, yeah, I will. So what I do is, so I'm talking about jumping on Zoom. So what I do is I put up it should already be there for next week, but I haven't chosen the topic yet for next week. So once I put it up, you could send me a message, hey, can I hop on this one or whatever, and I'll be sure to send you the link. But feel free to drop your questions in the chat as well, and I will be glad to answer. All right. So let me stop the sharing real quick and go back to the candidate handbook and pull that up for you. All right, so with the handbook, we just talked about LTV. So know how to calculate that and understand that it's a matter of percentages, right? So simple enough. PMI, private mortgage insurance. That's the insurance policy for a conventional loan. So it's for conventional loans only. There's a different one for other types of loans. But PMI, private mortgage insurance, that's an insurance policy that a borrower will pay if they don't put up to 20% down for a conventional loan. All right, so it is PMI. Now down to interest. Remember the word usury for interest. Let me type that on the screen. All right, S-U-S-U-R-Y, usury. Okay, if you know what this means, feel free to type it in the chat, and I will wait for a quick second and tell you what it means. So if you know what usury means, feel free to drop it in the chat. So with usury, there are maximum interest. There are some laws that require that you don't charge an interest rate up over a certain amount. So essentially the threshold, the highest interest rate you could charge when someone borrows money. Now, usury is if you charge more than what's allowed. In Illinois, there isn't any usury laws for real estate transactions. Essentially, when someone borrows money for the purchase of real estate, there are no usury laws. So there is no maximum interest rate that could be charged to anyone who is getting a loan to purchase real estate in Illinois. All right. However, there are federal guidelines and things like that some of the loan officers have to, sorry, not the loan officers, there are some Fannie Mae, Freddie Mac guidelines. And so that kind of helps keep the interest rates bearable, all right? Because otherwise they could charge whatever they want, which they kind of have a right to, right? Because they're borrowing their money out. And that's why when you get some non-conforming loans or loans that don't fall into the guidelines, the federal guidelines. So I'm sure you guys have heard people talk about hard money and some other types of loans out there. Now, those ones are not bound by these restrictions. And so you could see interest rates in like 10% or 7%, even before now that regular interest rates are trending higher, right? So people were paying higher at that point as well. So there is no usury law essentially in Illinois for the purchase of real estate. Oh, the other thing is be aware of how to calculate the interest on a loan amount. So if they give you a loan amount and ask you to calculate the interest, know how to do that for the exam. Now, one other thing to remember about interest, and it's part of the federal requirements, federal laws that come here under TRID and the Truth in Lending Act, RESPA, and all of that. Now, with interest, anytime you see an interest rate, know that the interest rate is per year. So if you see an interest rate of 2%, it's 2% per year, or 4.5%, it's 4.5% the entire year. And it's not per month or every 2 weeks or whatever. So that's one of the things that were done. I think it was with RESPA, because it provided some transparency in lending. So then whenever they give you an interest rate question, always remember that it's for the whole year. So let me throw up my blank screen again, and then I will do an example of interest. 1 second here. So okay, so now if I wanted to, let's say a person had, they borrowed $350,000, okay? And the interest was 7%. Now the question is, how much is the monthly interest rate? The monthly interest. Okay. So that's one question here. So like I said just earlier, this 7%, right, is for the whole year. So if you're getting charged 7% for the whole year, it will be 7%, okay, times 350,000, 1000. Okay, so if you do that on your calculator, you should have 350 times 7%, and that is, oh, you know what? Actually, I think I'm going to do something different that will make this easier to read. Let me use this here. All right, so 7% times 350. Let me just do that math again, because times 7%. Okay, it's correct. 24,500. Okay, as our dollar amount. Then, like I mentioned, and also this is a hint. This is such a large number. It can't be the monthly interest, right? It's $24,000. That's a lot. So that should be like a hint to you. That should kind of let your brain know, okay, this is not the final answer, because the interest, hopefully, right, should not be 24,000 for someone. So then what you would do is divide this by 12. So 24,500 divided by 12, and that will give you the monthly interest. And that is 2,041.67. Okay. All right. So, any questions on the stuff that I've covered so far? Feel free to put them in the chat. Okay. And again, this is going to be available afterwards, so you can always go back and rewatch these and take notes again. Use them as you're solving other questions that you may get in your textbook, or as you're doing practice quizzes. Use them as a guide to help you arrive at the right answer. Okay. So this is for calculating interest. Always remember, it's per year. It's not a monthly interest rate. Okay. So I'll take this down real quick, and then look at our handbook one more time. Okay, so we've talked about points, loan to value, PMI, interest, right? And so the next one is PITI. Again, this is another math type question. So PITI, principal, interest, taxes, and insurance. And you will use this, trust me, you will use this in your practice as well when you're working with buyers. So it's something that you need to know, like at the tip of your tongue, what this means. If you own real estate too, you're doing this as part of your monthly payments for the most part. Some people don't, but the average person does. So principal, how much you're paying back towards the loan. Interest, how much you're paying in addition to the principal. So paying for using someone's money, right? That's interest. Interest is what you're charged to use someone else's money. So you're paying that back every month. Taxes, we have property taxes. And so what they do is they divide it by 12. The annual property tax is divided by 12, and that's what you're paying every month. So when then the bill comes for your taxes, the lender will send the payment to your county. So you don't have to send any bill to the county when the tax bill comes. So you don't have to send any payments to the county when the bill comes. And then finally, insurance. The lender will require you to have homeowners insurance, and that's also paid into an account monthly. So when they get your PITI, they separate the P and the I. So they separate the principal and the interest, and then the tax and insurance go into a separate account, and the money is kept there for when the bill is due. And the money from there is used to pay your bill when it's due, right? And the last one, financing instruments. Please understand what a mortgage is. Also understand what a promissory note is. And the other one that's not on here, just because it's not as familiar, but it's probably under where it says etc. Right? So it is the deed of trust. So I'm going to unshare this screen, and then I will show you a different screen that kind of breaks down the differences between them. Okay. All right, let's do this. And so here on the screen, I have a slide that shows you the promissory note. Okay. Yeah, promissory note, first thing. This is the borrower's promise to repay the debt. So financing instrument is essentially the documents you sign saying that you're getting the loan. And for real estate, there are two things you always have to sign. If you're getting a mortgage loan, you sign the promissory note and then the security instrument. Sorry, let me say that again. In real estate, there are two things you must always sign: a promissory note and a security document. The promissory note is saying, yes, I'm borrowing this money from you. Security document is saying my house is collateral for the debt. Okay. So first document says, yes, I owe you X amount of money. Second document says, I owe you that money and my house is collateral or security for what I owe you. Okay. So if it's a mortgage loan, the two documents would be the promissory note and the mortgage. The mortgage in and of itself, okay, is a document. It is not the money you're getting. The mortgage is a document. So in the questions and in your book, you will see them say mortgage loan, right? Because the loan is the money. The mortgage itself is a document. So please, like, you have to make that mental switch in your head, because even when I'm talking with, regular people, we always say, oh yeah, I have a mortgage, right? Or I'm paying off my mortgage, or da, 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 da. And we kind of see that as the loan, but technically the mortgage is a document. Okay. So everyone borrowing to purchase real estate is going to sign two things: the promissory note and then the security document. For mortgage loans, it's the mortgage document. For the deed of trust, it is the deed of trust that you will sign. Okay. The mortgage document, the borrower gets a title to the property. So they have all the ownership documents, but the lender puts a lien on the property and says, if you don't pay my house, this lien is, if you don't pay off the money you owe me, this lien is there and I could enforce it to make sure that you pay, or I could sell the property or take back possession of the property and try to recoup my money that way. All right. Now, the difference between the mortgage and the deed of trust is sort of what I have here on the screen. So again, we have the promissory note. In this case, it's a trust. So whenever you see a trust, there are three parties to a trust: the trustor, the trustee, and the beneficiary. There are always three parties to a trust. So the borrower, the lender, and a third party. Don't worry about who the third party is. The lender will pick one or whatever. Don't worry about who the third party is, but just know there is a third party. So then what happens is, this is step one. All right, so just follow with me. The trustor, who is the borrower, is getting money from the lender. All right, so they get the money to purchase the property from the lender. They give the promissory note to the lender. All right, so we have the promissory note as one document. Then they also sign the deed of trust, but then this deed of trust is given to the trustee. And this trustee, it's a fiduciary duty, so they're like a responsible party, right? An attorney, a title company, whatever it may be, right? So they're holding on to the title on behalf of the beneficiary, so that if this borrower defaults, they give them the title documents to the property. Okay? So that's the premise here. Now, on this side, step two, let's say this person, the borrower, did not default. They paid off the entire balance. Now, the trustee will give them back the deed of trust. So there's a release of deed, and now this person is no longer a borrower, but they completely own the property free and clear. All right. And then this entire relationship goes away. Right? So let me see if you guys have any questions on any of this stuff. So if you do have any questions, please put them in the chat for me, because so that I know if this is all making sense. Okay, or give me a thumbs up in the chat or something, just so I know it's all making sense. Also, if there is a part of financing that you want me to specifically cover, all right, please drop it in the chat as well. Okay. All right, let me see real quick. Says, will you be doing another of these reviews? It will be on here afterwards, so you could always rewatch this, and I'll save it on here. And the plan is to do this every Monday for an hour from 12 to 1. So feel free to jump in at whatever time. And yeah, if you miss it, it's gonna be here. You can come back and watch it again. Right? So don't worry about that. Okay, so yeah, so definitely know the financing instruments. And I'm looking here at the chat, at the candidate handbook. So the next section is the types of loans. So let me show you this slide here for the types of loans. Now for the exam, don't worry too much about remembering these numbers, okay? But these are like your average numbers, and I'll talk about what they are, but just wanted to point that out there. All right, so earlier we talked about down payments, right, for a conventional loan. So if you're putting 20% down, earlier I said, then your loan to value ratio will be 80%, because these two numbers have to add up to 100. So if you look here on the FHA, minimum down payment is 3.5%. And here we have 96.5%. So if you add those two numbers up, you get to 100. So that's the relationship between your down payment and your loan to value ratio. Always adds up to 100. And we mentioned PMI briefly earlier. If you put less than 20% down, then you'll be paying PMI. One thing to remember about PMI, and this is for after you get your license, right? It's a good way to let your clients know that, okay, you're getting PMI now, but if you pay off your loan to a certain degree, PMI goes away. So it's not forever. It's until you own 22%. And the bank will calculate when that will happen. All right, and it will automatically drop off. However, a homeowner can also initiate the termination of PMI if they have 22% equity already in their property. So either during a refinance or something, you figure out, oh, I have more equity than I thought I did. Or maybe you're watching the trend in your market and you notice that the values have increased. Okay. So then this person can eliminate PMI if they own over 22% of their property, right? Alienation clause. Let's talk about that briefly, or it's also called a due on sale clause. So remember, this is how I remember it, right? I remember that alienation clause and due on sale are the same thing. So what does that do for me? It helps me remember that what this means is this loan is due on sale of that property. So certain lenders will not allow a loan to be assumed. Assumption is, I'm trying to think, I think it's also covered in the financing chapter. This is where a buyer can take over the payment or the loan of the seller and essentially continue making those payments with the lender's approval, of course, right? So a full assumption is the lender has reviewed the buyer. The lender says, okay, you meet all our criteria. we're okay with you assuming this mortgage. Why was this done? It was done at times, I know interest rates are high now, but there was a time interest rates were 18%. Okay, so let's say I bought when it was, oh, it can even be now. I bought when it was 2%. All right, and then now it's 7%. So when you're buying my house, you would take over my 2% interest rate versus getting a new loan for 7%. Okay, and that could happen at any time, right? Except if in your mortgage documents, right, your loan documents from the bank, you have an alienation clause or a due on sale clause. So the due on sale clause will prevent an assumption. Okay, prevent a loan assumption. Loan assumption prevention, right? The due on sale clause only applies for conventional loans. It doesn't apply to these other loans I have here on the screen that are either insured or guaranteed by the government. Okay. And with the conventional loan, there is a higher debt to income ratio. Debt to income, how much debt you have as a percentage of your monthly gross income. All right, so let me type that on the screen real quickly. So debt to income, or DTI, is how much debt you have as a fraction of your gross monthly income. So what happens is, let's say your gross income is $5,000, okay? The first percentage here, like the 28%, right? That's for PITI. So your PITI should not be more than, in this situation, okay, 28% of your gross income. So it should be less or equal to 28% of your gross. Let's just do GMI, okay? GMI is gross monthly income. Then the second percentage is PITI plus other long-term debts. Okay. And in this situation, it should be less or equal to 36% of your GMI, your gross monthly income. Okay. So again, this is just an example, because you remember I told you don't memorize these numbers. If you're getting a question like this on the exam, they will give you the percentages to work with. Okay. So for someone who's earning 5,000, if you do 28% of 5,000, 5,000 times 28%, 28%. That's 1,400. Okay. Okay. Oops, change the whole color. I was just trying to change one color, but I guess I can't. All right. And then if I had 36% of 5,000, and that is 1,800. Oops. Okay, so this would be $1,800. So this long-term debt, what it means is, for example, if someone has a car note, if someone has credit cards they're paying off, a personal loan from the bank for some reason, or yeah, just like other things that you're paying off monthly. So what they're going to do is they'll get your potential PITI and add that to your long-term debt. And those two together should not be more than 36% of your gross monthly income. So that's just in this example, right? In some instances, the percentages may be higher or it could be lower, right? So this is what the lenders will do to help qualify someone for a mortgage, right? And it's good that we know this so that if we are working with clients who are having difficulty getting financing, right? You kind of understand why they're having difficulty, right? Question, I'm trying to see what requires written consent from seller. What do you mean in terms of what? Okay, G Garcia, let me know. I'm trying to see what requires written consent from seller. So in terms of what? All right, next question. I'm doing a bunch of studying this week for my national party exam for next week. So I'm gonna write down a whole bunch of questions I have for you. Okay, sounds good. Do you start from chapter 1 and go through the entire book, or do you just do certain topics? I do certain topics just because everyone has different books. So your book may be different from the book someone else is using. I actually have 3 different books and they are all in different orders. So I can't necessarily go through like chapter by chapter. All right. And I'm not sure what school you went to, so I don't know which book you are using. Okay. So I hope that answers your question. All right. So let's stop sharing real quick. Let's look at our candidate handbook. So in your financing chapter, there are different terminology, right? For example, know what amortization is. And let me share the handbook because it talks about it right here on the handbook. Okay. So let me share the handbook real quickly so that you can see what I'm talking about and the words that I'm using. Right. All right, so amortization. Know what that means for sure. Amortization is where when you're making monthly payments, whatever you're paying off, whatever your monthly payment is going towards principal and interest. So your monthly payment is paying down principal and also paying into interest. What that does for you is that it helps you pay down the loan at a steady rate, right? So you're paying off principal and also paying into interest at the same time. Now, a non-amortized loan is one where, for example, you're only paying the interest. And there is one thing called a straight loan. So a straight loan is an example of an interest-only loan. So you're only paying the interest. And then at the end of the term, so let's say it's a 6-month loan. So every month you're paying the interest. Then after 6 months, you pay off the full principal. Versus an amortized loan where every month you're paying some of the principal, some of the interest, and by 6 months, you're paying everything off, right? And now you're at zero. Now, a fully amortized loan. So when it is fully amortized, okay, F-U-L-L-Y, fully amortized. A fully amortized loan is one whereby they've done a calculation, and I have a video, the video where I did the amortization table. I talked briefly about this at the beginning, and that was where I said there's a formula they use so that your monthly payment is exactly equal every month, and at the end, your monthly payment equals your balance. And then once you pay that monthly, the last payment, you're at zero. So you're essentially paying the same thing for the life of the loan. Versus one that's not fully amortized. So an example of one that's not fully amortized is a balloon payment type. Okay. Balloon. So think about it. You're making your monthly payments, but then at the end of your term, you have a large balance that's due. And then someone gave the analogy of like at the end, you have to pop this balloon, right? You have to essentially pay off a large chunk. So let's say you have a loan for $10,000, all right? Every month you're paying back $50 towards principal and the interest as well. So you're paying $50 every month, and then you're paying the interest as well. The loan is for 6 months. At the end of 6 months, you're going to pay the difference in the principal, because remember, you've only been paying $50. So $100,000 minus what you've paid so far, and that huge chunk is due at the end. Right? That's an example of an amortized loan that's not fully amortized because your final payment is larger than what you've been making as payments every month. Okay. We have fixed rate loans. We also have adjustable rate loans. So what that means is the interest could adjust up or down depending on some economic factor. Right. Let me check real quick in the chat. Okay, so in the chat, it says, as in a lockbox or for sale sign, do we need written consent for something specific when listing? All right, so I'm also looking to see if Illinois allows vehicles as gift for property purchase. 10 years ago, condos, my house, offered a car purchase, but I can't find anything about that either. All right, I'll address that at the end, okay? Because that's a different topic. Okay, I'll address that at the end. All right, so real quick, before we wrap it up for today, some other things to remember for financing, right? Know the laws, truth in lending laws. Sorry, let me remove all these things from the screen. Okay, so know the truth in lending laws. Essentially, we need clarity, all right? Borrowers need to know details about their loan know what you owe before you own. Know what you owe before you own. It also prohibits real estate agents from getting some kickbacks or referral fees from lenders. Equal credit opportunity prevents discrimination when someone is trying to obtain financing or a loan. So a person should not be discriminated against for, like with the protected classes, right? So remember fair housing. So it ties into lending as well. So there should not be a discrimination based on your race, gender, religion, national origin, all of those type things. The other thing that equal credit opportunity adds on is the fact that public assistance and your source of income should not count against you when you're applying for a loan. So if someone is getting disability checks or getting alimony checks or getting child support checks, those checks should count as their source, as their income, and it shouldn't be used against them when they are applying for that loan, okay? Instead, it should boost their income. It shouldn't work against them. Now, here's one thing that is going to be Illinois law as of January 1st, 2022. Speaking of sources of income. So some people get housing vouchers. Now, Illinois is going to require everyone to accept them as a landlord. It shouldn't be the reason why you reject people from housing. So it's becoming law, not just, right now we have it in Cook County. So we've had it in Cook County for a while, but now it's becoming Illinois law all around. So these are some things that we as real estate agents need to be aware of and keep in mind as we're going, because these laws are also changing. So under equal credit opportunity, your source of income should not be used against you when you're applying for a loan. And then in this case, I just mentioned now, trying to get approved to rent a property. You could use other criteria, but that should not be the reason why people are rejected. You can't say, no, I don't accept Section 8. No? although some people still say it now in Cook County. So we got to know the laws as we get into practice. I don't know the fine for these type things, but sometimes the fines can be steep. So please be sure to not just make these notes for you to pass the exam, but there's some things you need to know after you pass the exam. All right. And with underwriting, debt ratios, I mentioned as we were covering that table, credit scoring, credit history, those kind of count against you. And I'll go back to the table real quick before we wrap it up today. So those things, I just wanted to make sure we get through this list, and then I'll finish up at the table and then answer the question in the chat. All right. So that is it for financing. And like I mentioned last time, you could print this. I always leave a link to it in the description below. If it's not there now, I'll add it later. But you could grab this and just make notes beside these terms, right? What do I remember about conventional loans? What do I remember about VA loans and FHA loans? All right. So that is it for the candidate handbook. Let me go back to our slide here and just wrap up with that. Okay. All right, so we were talking about conventional, and then the next one would be FHA and VA guaranteed loans. So one thing to remember, it's not on that list, but know the secondary and primary market. Okay, secondary and primary markets. Primary markets are where we originate loans. Primary market, where loans are originated. And then secondary market is where loans are sold. So why do I bring this up? Sometimes they may throw this thing at you where they ask you, which of the following is an example of a secondary market? Okay, examples would be Freddie Mac. Okay, Freddie Mac. Know what that means? Fannie Mae and Ginnie Mae. So they may ask you, which of the following is an example of a secondary market? And then the options would be FHA, VA, and then maybe Freddie Mac and a blanket loan. All right, so you want to know that the answer for that would be Freddie Mac. Now, why did I bring that up? FHA in and of itself does not make loans. The Veterans Affairs Office does not make loans. What FHA does, the Federal Housing Administration, they insure the loan on behalf of the borrower. And then what the VA does, the VA guarantees the loan on behalf of the borrower. So where do people go to get FHA loans? They go to the primary market to get FHA loans. Where do people go to get VA loans? They go to the primary market to get VA loans. And then the loan is guaranteed by the Department of Veteran Affairs because this individual is either active military or a veteran and has this VA benefit. Okay. So please don't let that confuse you. The way we say it in our normal terminology, FHA loan, is actually a misnomer because FHA is not giving you the loan. The primary market person, the lender, is giving you a loan based on the FHA guidelines, right? So that FHA will insure that loan on behalf of that borrower. Same thing with the VA guaranteed loans. All right. So that's the main thing to know about them, that they insure and guarantee the loans. They don't make the loans. And these government loans are for owner occupancy only. You can't use them to purchase investment properties. And you can only have one VA insured loan or one VA guaranteed loan or one FHA insured loan at a time. Okay. And the MIP is same to PMI, but it's just a different terminology from PMI. Right? So let me address the final question here. Bob, yes, it is a new laws of January 2023. Yeah. I can drop a link for you actually in the chat. I'm responding to the question about FHA type loans and stuff. Yep, it is new as of next year. All right, so please be aware. Okay, then the question about seller consent. Okay, for sale signs, yes. Okay, for sale signs, 100% yes. You must have permission from the seller to advertise their property, even putting for sale sign in front of the house. That could be a potential test question. You always need their permission. You have, with your brokerage agreement, you have the agreement with them to bring a buyer, to help them sell the home, okay? But in some of our documents, we also have the verbiage, you know, we don't write them, right? So you have the verbiage in there that talks about if they're going to allow you put signs in front of the property and things like that. But yes, on the exam, you always need your seller's consent to advertise the property. Even pushing it to third-party websites, the one that we use, we have something in there where the seller has to agree to it, or they could say, no, we don't want this to happen. And so it will not be pushed to third-party websites. That's why if you look on some third-party websites, you may see a property that's for sale, but then the address is not listed. That's because that's been withheld. So there are some things like that. Lockbox, I would say yes, get their permission because you're putting it on their property. It could just be an email. It doesn't have to be an official thing, but just have something in writing. The other reason why you must ask about for sale signs is what if they live in a condo association that does not allow those signs? So you want to make sure you get clarification first before you go ahead and order the signs. Because if you put the sign up, they will get fined by their homeowners association. So please do make sure that you clarify. The other thing I will mention, you didn't ask that, but I'll mention this as well, even with showing the property after it's under contract, okay? According to the law, the property is for sale until it has sold. So part of our duties to our clients, and this is under the minimum services that we provide to all of our exclusive brokerage agreement clients, you present all offers or counter offers until closing, okay? Until closing, except you have written consent from your seller to do otherwise. Right? So if you want to if you have a property under contract, ask your seller, do you want to still allow showings? They will say no. There's a way you can mark that on the MLS, all right? So people don't reach out to you to show the property after it's under contract. So all of those things, yes, you do need consent for. Buying property with a vehicle, I believe you can, because it's still consideration, but how that would look on paper, I don't know. That would be a question for an attorney. But I believe you can sell property for a vehicle because it's the value for value, right? It's like an exchange. But how that would look on paper, I don't know, because we don't draw up those documents as real estate agents. So I hope I was able to answer your question. Would you see something like that on the exam? Most likely not, because that's kind of outside our scope. But under contract law, know that under contract law, there must be legal consideration. So I'm giving you my house for something in return. So the thing in return could be a vehicle, it could be stocks, it could be Bitcoin, it could be love and affection too. So there's valuable consideration and there's good consideration. So it could also just be a gift for the exchange as well. Okay. So I hope this was helpful to you guys. G. Garcia, let me know if I answered your question, if you have any other questions. And if not, we will kind of wrap this up for today. And then, like I said, next week as well, same time, same place, I'll be here with a different topic. If someone has a topic they want me to cover, do let me know. And yeah, I can plan for that because I think someone had recommended financing. So that's why we're doing that today. Be sure to check out the other videos I have with training, with, videos for you guys to watch. And then the last thing I wanted to mention is, right. So that's what I said. Sorry, I just saw your comment, as in, can a car be offered as gift with purchase? Yes, right. But how that looks on paper is what I'm saying. I don't know. So an attorney will have to draw up the documents for that type of transaction. Or the owners can figure out how to transfer the ownership between themselves. But for me as a real estate agent, I personally won't be able to like tell someone how that's going to look on paper, if that makes sense. I hope that makes sense to you. But the simple answer is yes. However, how it looks like, I can't tell you. Okay. All right. Okay. All right, everyone. Well, have a wonderful, wonderful week. All right. If you're studying, I wish you all the best. After you get your license, I'm sure you're going to be thinking about, where to go and all of those things. If you wanted to talk about that too, feel free to reach out. Where I work, we have like lots of training that's available. I also am part of a different team that does a lot of weekly trainings and support and all of those. So feel free to reach out if that's also something that you were thinking about after you get your license. All right. Take care, and I will see you all next week.